Hello, my people. It's your village boy again. Thank you for subscribing to our channel. Thank you for watching. Thank you for sharing with your friends. Sharing is love. Love is sharing. Thank you. Based on our previous episode and some questions and responses we have received, today we want to look at what is called the break-even point in business. The break-even point. And then we also look at the cost, volume, and profit analysis. So the two are somehow related, but I will take them one after the other. In previous episode, I mentioned what constitutes the part of the cost of sales, which sometimes people call variable cost, your direct material, your direct labor, and your direct overhead. Then also, previous to that, I discussed the concept of markup, margin, and the pricing of goods and services. In terms of break-even point, we are looking at how much of your margin will you need, to get to a point of break-even point. Okay, for definition purposes, break-even point is that point which you either make a profit or a loss, in which case your total cost of production is equal to your total revenue. So your revenue and your cost of production are the same. No profit, no loss. Now, when I was discussing margin, I explained some basic principle to you that in your margin, if your margin is narrow, that you need to sell a lot of quantity to be able to make profit. Of course, the first step that you have to break even first, then you talk about making profit. Now, the margin, which I've explained, which is different between the selling price and the cost of sales, is your margin. And the margin, after that, which I also said that the accumulation of margin is what gives you your gross profit. So, and your gross profit, you still have to other expenses, which you have to take out from your gross profit to be able to get to a point of whether you are making profits or you are not making profits. Now, a situation whereby your gross profit and your other costs, sometimes is categorized as fixed costs, all other expenses, all other indirect material, indirect labor, indirect overheads, when you put them together and they equal your gross profit, that is the point you will call the break-even point. And you can determine that break-even point by the number of quantity you can sell. Yes, you can determine the break-even point by yourself. How do you do that? First, you have to determine what is your margin. If your margin is maybe, let's say $10, using dollar as a part of unified currency here, and you look at all other costs that are not part of production costs, all other expenses, all your insurance, your electricity, your advertising, your marketing expenses, your salaries, your workers, that are not production workers, your sales team, your account team, and all other, expenses that you incur. When you put all these together, you have a figure. So that figure that you have as the other costs, which sometimes is generally categorized as fixed costs, because these costs are not dependent on the volume of your activity. I explained that in previous video. So it's just like these are costs you will incur, irrespective of the volume you are selling, irrespective of the quantity of good you are selling or the services you are rendering. So after these broad categories, when you put all this together, then you divide that price, that cost, that fixed cost, that other cost that are not directly attributable, to the unit of product you are selling. So when you put them together, you have a whole figure. So you now divide that figure by the margin. For instance, if your margin is $10, for instance, for selling a unit of your product, and let's say your other total cost is like $10,000. So you now divide that 10,000 by the 10. That is $10 a unit. We contribute. Sometimes people call it contribution. It's the same thing, margin, contribution. They are actually the same word that you can use interchangeably. But let us stick to margin for this purpose. So you divide the total cost after gross profit with the unit. You are using the unit now of the gross profit of the margin to divide that total cost. So in this case, 10, maybe it's, let's say 100,000 is your total cost, and you are dividing it by $10 per unit. That is the contribution of the margin per unit. So that will give you an idea of the quantity you must sell to break even. So when you divide 100,000 by 10, what do you get? You get 10,000, which means if you sell less than 10,000 units of that product, you are not going to break even, meaning you are going to make a loss. But at the point you sell 10,000 units, you are saying you have now be able to cover all your costs. So your total revenue and your total cost of production, all variable fees and everything together, will be equal. So you are not making profit, you are not making a loss. So that is called the break-even point for simplicity. Like I said in previous, in the past, your gross profit is not your bottom line. Now, accounts, let me also tell you something in terms of taxation now. Now, if I get to a break-even point, which I do not make a profit and I do not make a loss, is it possible that I will still pay tax? The answer is yes. And this is the reason why. When you are at the break-even point and you file in your returns to the tax authority, what they will look at, your other expenses after the gross profits, they will scrutinize it very well. And if there's an expense that they consider not appropriate, we call it disallowable expenses. If there is anyone, they will charge it back. And when they charge it back, it will reduce your other costs. It means you, instead of having a zero profit, you will now have a profit based on the disallowable expenses. Why would they disallow expense? There are so many factors. There are many reasons they will do it. Especially if some expenses classification is ambiguous. For instance, you say public relations. People know that people hide under this kind of expense structure to just load figures. So the tax authority may think that no, it's either you explain, give a breakdown of what is public relations or miscellaneous expenses. People say miscellaneous expenses. When you use this term in your financial statement, the tax authority has the power to disallow it. Or sometimes they will ask you to give a breakdown, a schedule, and a proof of what constitutes miscellaneous expenses or public relations. I remember in the time past, a lot of business were hiding other public relations, and they will see the figure. And when you see the figure and you compare it to other expenses, if it looks unreasonable to the tax authority, they may disallow it. So there are instances whereby you may make a zero profit, by your financial statement, by your financial report, and the tax authority can still charge you to pay tax because they have disallowed some expenses. Does it mean you did not incur that expenses? It may not necessarily be so. It may be because you wrongly classify your expenses. So most accounting professionals will understand this, and your auditor should be able to give you advice on the proper classification of your expenses. Note of warning, the auditor will not prepare your financial statement for you. Nowhere in the world that the auditor prepares it. The job of the auditor is to express opinion as the true and fair presentation of your financial statement. Of course, your consultant can do this. Your consultant will advise you when he looks at what you have done, whether it is properly, in alignment with what the tax authority will accept or not accept. Let me not go too deep into taxation. Maybe, I don't know, one of these days, I may take time to explain this further. Now, after the break-even point, there's another thing that people do. If you determine your break-even point, you can also determine, okay, I want to make so number of X number of profit. You know your break-even, you know your margin, you know your other costs, other expenses, and you want to determine, okay, I want to make X dollars of profit. Then what you are going to be looking at is your cost volume profit analysis, which is called CVP analysis. And it's just a step further, to the break-even point. Now, you will, instead of dividing the margin, which is the contribution, by the other fixed costs, other expenses after your gross profit, you will add those costs with the number of dollars, the number of profits you want to make. You want to make X profit after you have recovered your costs. So you add that to the fixed cost. So you now divide that again by the margin. So this will now tell you, okay, if I want to make X amount of profits, this is the unit of product I have to sell. Of course, I told you one of the previous video that this is where velocity comes in. I mean, how much volume you want, how much quantity you have to sell in order to, make profit. So you can determine this ahead of time. That you must be able to have your calculation right from the beginning. So you know what your fixed cost, your variable cost, your direct cost, which is your cost of sale is. Then you determine what markup you want to put on it, especially taking into consideration factors which I already discussed in the previous video. When you have determined that, and when you now take your selling price and you remove your cost of sales or cost of production from it, you get your margin. So with your margin, you are able to determine the quantity you can sell, either to break even or to make a predetermined profit. Yes, you can determine you want to make this level of profit. Of course, you do know when you have understood the number of quantity that you have to sell. If you don't sell that quantity, you will know you will not make the desired profit. Also, you have to first determine how many you have to sell to break even. If you are selling below that, you know that you are not breaking even. So that is why these calculations are very important. And because if you have not achieved the targets of breaking even or making profit, then you'll be mindful of how you spend money. Because the danger here, the temptation is always there. When you are doing business, money is coming in. People, especially small business owners, they don't differentiate between money that can be spent and the money that cannot be spent. Yes, it's not all money all revenue that you generate you can just spend anyhow. because you may end up making losses. But because you are seeing the cash, which is one of the limitations of cash flow, because you are seeing the cash, you spend it the way you see it. And that is why sometimes, especially if you are in a business where you collect deposits before you supply goods or services, that money you have not earned it because you have not supplied the goods and services. So if you spend that money recklessly, you may be shooting yourself on the foot. So you need your margin to determine your break-even point. Your break-even point is a point where you are not making profit, you are not making loss. That's the point where you cover all your costs. That is what is called break-even point. And of course, there is a possibility to still pay tax at your break-even point, especially if the tax authority disallows some of the expenses you have classified in your report. Then, when you want to make a certain predetermined level of profit, your margin also enable you to calculate the quantity, number of quantity you must sell to be able to achieve that. One of the benefits of this calculation is this: it helps you to determine the kind of marketing strategy you want to deploy. How do you reach the market? How do you expand your market? So all these, they have their own purpose to serve. And if you are in business, you must understand these basic principles. I've tried to speak to them in its most basic elements. But those are the things you do to be able to know that, okay, I am making even, I break even, I am making profit, or I'm not making profit. Of course, it is imperative that you should keep record. If you don't keep record, you may not be able to determine what you have achieved. Thank you. Till I come your way again, don't forget to subscribe and share with your friends. God bless you.